Silver, already $72 in Shanghai. Banks in crisis. The Monday Massacre just hit. At 9:30 a.m. Eastern Time this morning, something unprecedented occurred in the global metals market. Shanghai opened, and silver was trading at $72 per ounce. New York, $69, a $3 gap between two markets that are supposed to be identical. This is not a glitch. This is not a temporary anomaly. This is the signature of a system breaking in real time. The arbitrage window is closed. The physical metal is diverging from the paper contracts. And the banks, the ones holding billions in short positions, are now trapped in a position they cannot escape. What you are about to hear is not speculation. It is strategic analysis of a market event that will rewrite the rules of global finance. The question is not if this explodes. The question is, are you prepared for what comes next? Welcome to Financial Announcement. My name is David Richardson. I'm a former commodity analyst based in Chicago, Illinois, and for the past 17 years, I have tracked institutional money flows in the metals markets. Today, we are documenting a historic market dislocation. Before we begin this analysis, I need you to do something important. Look at the bottom of your screen. You will see a subscribe button. If you have been following financial markets for more than a decade, if you remember what happened in 2008, then you understand the value of being informed before the crowd realizes what is happening. Subscribe now and leave a comment below. Tell me which country you're watching from. This is a global event, and I want to know where our audience is positioned. Now, let us begin. The markets opened in Shanghai at precisely 9 a.m. local time on Monday, December 22nd. Traders across Asia sat at their terminals, watching the price feeds populate their screens. Silver futures contracts began trading immediately, and within the first 60 seconds, the price was $72 per ounce. In New York, where trading had not yet begun, the previous closing price stood at $69.14, a $3 gap. In the world of commodity trading, this gap is called an arbitrage opportunity. Under normal conditions, arbitrage opportunities disappear within minutes. Traders in one market buy the cheaper asset, and traders in the other market sell the expensive asset. The prices converge, the gap closes. This is how global markets are supposed to function. But on this Monday morning, the gap did not close, it widened. By 10:05 a.m. Shanghai time, silver had climbed to $72.30. New York was still asleep. The European markets were watching but not intervening. Something had changed in the fundamental structure of the silver market. The physical metal was separating from the paper contracts. David Richardson had seen this pattern before, not in silver, but in other markets where supply and demand had become disconnected from price. He remembered the crude oil market in 2020 when futures contracts went negative. He remembered the nickel market in 2022 when the London Metal Exchange had to cancel trades because the price moved too fast. This was the same signature, a market under extreme stress. He opened his trading platform and began pulling historical data. For the past 10 years, the price difference between Shanghai and New York silver had averaged less than 20 cents per ounce. On rare occasions, during moments of currency volatility or shipping delays, the gap might widen to 50 cents. But $3 was a structural break. Richardson began analyzing the volume data. In a normal trading session, Shanghai silver futures trade approximately 40,000 contracts in the first hour. Today, the volume was 112,000 contracts, nearly triple the average. This was not retail speculation. Retail investors do not wake up on a Monday morning and collectively decide to buy massive quantities of silver futures. This was institutional. This was forced. Someone, somewhere, was being compelled to buy, not because they wanted exposure to silver, but because they had no choice. Richardson pulled up the Commitment of Traders report from the previous week. The report, published by the Commodity Futures Trading Commission, shows the positions held by different types of market participants. Commercial traders, mostly banks and mining companies, were short 83 million ounces of silver. This meant they had sold contracts promising to deliver 83 million ounces, without necessarily owning the physical metal. It was a bet that prices would fall, but prices had not fallen, prices had risen, and now those commercial traders were losing money on every dollar the price climbed. At $69 per ounce, the loss was manageable. At $72 per ounce, the loss was significant. At $75 per ounce, the loss would become catastrophic. The mechanics of what was happening were simple. When a trader holds a short position and the price moves against them, they receive a margin call. A margin call is a demand from the broker for additional cash to cover potential losses. If the trader cannot provide the cash, the broker closes the position automatically. To close a short position, the trader must buy back the contracts they sold. And when they buy, they push the price higher, which triggers more margin calls, which forces more buying. This is called a short squeeze. And Richardson was watching one unfold in real time. He looked at the calendar. December 22nd, 3 days before Christmas. The senior traders at the major banks were not at their desks. They were on vacation. They were with their families. The people managing these massive short positions were junior staff members, individuals with limited authority and limited experience, and they were being forced to make decisions that could cost their firms hundreds of millions of dollars. Richardson thought about the physical market. The refineries in Switzerland were closed for the holidays. The mints in the United States had reduced their shifts. No new silver bars were being produced this week. No new coins were being struck. The supply pipeline had been shut off. But the demand was accelerating. Industrial buyers who had been waiting for a pullback were now realizing that the pullback was not coming. They were placing orders, large orders that needed to be filled in January when production resumed, and the dealers, the intermediaries between the mines and the factories, were running low on inventory. Richardson pulled up the spot price in New York. It was now 6:30 a.m. Eastern Time. The futures market would open in 3 hours. He watched the pre-market quotes, $69.40, $69.60, $69.80. The price was climbing before the market even opened. This was not speculation. This was not a technical breakout. This was a liquidity crisis. The physical metal was in short supply. The paper contracts were overextended. And the gap between Shanghai and New York was the visible proof that the system which had kept silver prices suppressed for decades was failing. Richardson leaned back in his chair. He knew what came next. When markets break, they do not break slowly, they break all at once. And the break? There's a principle in fluid dynamics called cavitation. It occurs when liquid flows so rapidly through a confined space that the pressure drops below the vapor point. Bubbles form, voids appear. The liquid begins to behave erratically. What was once smooth flow becomes violent turbulence. On Monday, December 22nd, the silver market entered cavitation. Michael Torres had been trading precious metals for 11 years. He worked for a mid-sized hedge fund based in London. His job was simple: manage the firm's silver exposure and keep the portfolio balanced. On a normal trading day, if Torres wanted to buy 500 contracts, he would place a limit order at the current market price. Within seconds, the order would fill. The price might tick up by 2 or 3 cents. Nothing dramatic. But this Monday was different. Torres placed an order for 500 contracts at $69.20. The order filled instantly. The price jumped to $69.50, 30 cents on a single order. He stared at his screen. That should not happen. Torres pulled up the order book. The order book is a real-time list of all buy and sell orders waiting to be executed. Under normal conditions, the book is deep. There might be 3,000 contracts waiting to be sold at $69.20, another 2,000 at $69.30, another 1,500 at $69.40. But today, the book was thin. At $69.20, there were only 400 contracts available. At $69.30, only 250. The market had no cushion, no buffer. Every buy order was chewing through the available supply in seconds. Torres understood what this meant. Liquidity had disappeared. In financial markets, liquidity is the ability to trade large quantities without significantly moving the price. It is the grease that keeps the machine running smoothly. Without liquidity, markets become brittle. They spike. They crash. They behave unpredictably. And during the final week of December, liquidity always declines. But this year, the decline was not gradual. It was catastrophic. The reason was simple. On December 20th, most major financial institutions had closed their trading books for the year. Portfolio managers had locked in their annual performance. They did not want to take new risks 3 days before Christmas. Senior traders had left for vacation. The trading floors in New York, London, and Zurich were operating with skeleton crews, junior analysts, support staff, people who did not have the authority to deploy large amounts of capital. And the market makers, the firms whose job is to provide liquidity by constantly buying and selling, had reduced their activity to minimal levels. They were not willing to take large positions during a holiday week. Torres thought about the implications. In a liquid market, a short squeeze is manageable. The shorts can cover their positions gradually over days or weeks, but in an illiquid market, a short squeeze becomes explosive. There are not enough sellers to absorb the buying pressure. Every purchase pushes the price higher, and higher prices trigger more margin calls, which force more buying. The feedback loop accelerates. He pulled up the options data. The options market was where the real danger lived. Thousands of call options had been sold at the $70 strike price. A call option gives the buyer the right to purchase silver at a specific price. If silver closes above $70, those options become valuable. The sellers of those options, mostly large banks, are required to hedge their exposure. They hedge by buying futures contracts. And the closer the price gets to $70, the more futures they must buy. This is called gamma hedging. In a normal market, gamma hedging happens smoothly. But in a thin market, gamma hedging becomes a runaway train. The algorithm does not care that it is December 22nd. The algorithm does not know that the senior risk managers are on vacation. The algorithm only knows one thing: buy. Torres watched the price tick higher: 69.50, 69.60, 69.75. Each move was accompanied by volume spikes that suggested institutional buying. He thought about the junior traders at the major banks. They were sitting at desks right now watching their screens turn red. Their positions were losing money. Their risk limits were being breached, and they had no one to call for guidance. Their bosses were unreachable, on a beach in the Maldives, skiing in the Swiss Alps, somewhere without cell service. The junior traders faced an impossible choice. They could hold the position and hope the price reversed, but if the price continued climbing, the losses would compound. By the time their bosses returned from vacation, the damage could be irreversible, or they could close the position now, take the loss, cover the shorts. It was the safe choice, the conservative choice. And across the global banking system, junior traders were making the same decision simultaneously. They were hitting the buy button, not because they believed silver was going higher, but because they were terrified of the consequences of doing nothing. Torres pulled up the physical market data. The refineries in Switzerland had published their holiday schedule weeks ago. December 23rd through January 2nd, closed. The Perth Mint in Australia, reduced operations. The US Mint, skeleton staff only. For the next 10 days, global silver production would be near zero. No new bars, no new coins. The supply chain had been turned off, but the demand side was awake. Torres looked at the procurement orders coming through the system. Electronics manufacturers in South Korea were placing forward orders. Solar panel producers in China were accelerating their buying schedules. They had seen the price chart. They knew what was coming. If silver broke $70, it would not stop at 75. It would go to 80, maybe higher. And every day they waited to secure supply meant paying a higher price in January. So they were buying now, in size, pulling future demand into the present. Torres made a decision. He placed another order, 1,000 contracts, market order. The price jumped 40 cents in 3 seconds. He did not care. In a liquidity vacuum, the old rules no longer applied. In a liquidity vacuum, speed mattered more than price, and the vacuum was getting deeper. Across the Pacific, in a trading room in Singapore, another analyst was reaching the same conclusion. The market was not behaving rationally because the market was no longer a market. It was a machine breaking down in slow motion. And the only question that mattered was how violently it would break. In 1974, a psychologist named Daniel Kahneman conducted an experiment. He asked people to estimate the population of African nations. Before they answered, he spun a wheel with numbers from 1 to 100. If the wheel landed on 10, people guessed lower populations. If it landed on 65, they guessed higher. The wheel was random, the number meant nothing, but it anchored their thinking. Kahneman called this cognitive bias anchoring. And on December 22nd, the entire silver market was anchored to one number: 70. Jennifer Caldwell managed a quantitative trading desk in Boston. Her firm used algorithms to trade based on statistical patterns. No emotion, no speculation, just data. But even her algorithms were reacting to $70. She pulled up the historical chart. Every time silver had approached a round number in the past decade, the same pattern emerged. At $29, it stalled. At $49, it reversed. At $69, it hesitated. Round numbers act as psychological barriers because human beings are not rational. They see $69.95, and their brain does not process it as nearly 70. It processes it as 60-something. But the moment the price ticks to $70.05, the perception shifts. It is no longer 60-something. It is 70-something. And that shift changes everything. Caldwell looked at the order flow data. There were 11,000 sell orders clustered between $69.70 and $69.99. These were limit orders. Instructions to sell automatically when the price reached a specific level. Traders had placed these orders weeks ago, anticipating that $70 would be the top. They wanted to lock in profits before the reversal. But Caldwell saw something else in the data. Behind that wall of sell orders, there was nothing. Above $70, the order book was nearly empty. Only 1,400 contracts were waiting to be sold between $70 and $75. This was what traders called blue sky territory, a price range where no significant resistance existed. She thought about what would happen if 70 broke. The 11,000 sell orders would execute. The buyers would absorb them. And then, nothing. The price would leap, not climb, leap. From 70 to 73 in minutes, maybe seconds, because there would be no sellers to slow it down. Caldwell pulled up a different data set. The inflation-adjusted price of silver. In 1980, silver had peaked at $50 per ounce, but in today's dollars, adjusted for 44 years of inflation, that peak was equivalent to $183. The current price of $69 was not expensive. It was cheap, historically cheap. The market had spent decades trading in a suppressed range, and now that suppression was ending. She thought about the miners, the companies that extract silver from the ground. Their production costs had been rising steadily for years. Labor costs, energy costs, equipment costs, regulatory costs. In 2015, the average all-in sustaining cost to mine 1 ounce of silver was $11. In 2024, that cost had risen to $23. At $69 per ounce, miners were profitable. But they were not wildly profitable, and they knew something the market was just beginning to understand. There was no new supply coming. Major silver deposits take 15 years to develop from discovery to production. The last significant discovery was in 2009. Since then, exploration budgets had been cut, junior mining companies had gone bankrupt, the pipeline of future supply had dried up, and the demand was accelerating. Every electric vehicle required between 25 and 50 grams of silver. Every solar panel required 20 grams. The energy transition was not a future event. It was happening now, and it required silver, lots of it. Caldwell pulled up a research report from a mining consultancy. The report estimated that by 2030, industrial demand for silver would exceed annual mine production by 400 million ounces. 400 million ounces of deficit every year. The only way to fill that gap was to pull silver from existing stockpiles, government reserves, commercial inventories, private collections. But those stockpiles were finite, and they were being drawn down. She thought about the Shanghai premium, $3 per ounce. In a functioning global market, that premium should not exist. Traders should be able to buy silver in New York, ship it to Shanghai, and sell it for a profit. But they were not doing that. Why? Because the physical metal was not available. The vaults were not releasing inventory. The refineries were not producing new bars fast enough. The arbitrage opportunity existed in theory, but not in practice. This was the signature of a physical shortage masquerading as a paper market rally. Caldwell looked at the clock. It was 11:47 a.m. Eastern Time. The price was $69.83, 17 cents from 70. She watched the order flow. Small buy orders, 5 contracts, 10 contracts, 20 contracts. Retail investors testing the water. They were cautious. They had been trained by years of false breakouts to wait for confirmation, but the institutional buyers, they were not waiting. A block trade flashed across her screen. 2,000 contracts, executed at market price. The price jumped to $69.92, 8 cents from 70. Caldwell's algorithm sent her an alert. Breakout probability, 73%. She ignored it. Algorithms could not account for human psychology. They could not measure fear. And right now, fear was the dominant force in the market. She thought about the short sellers, the traders who had bet that silver would fall. They were watching the same screen. They knew what 70 meant. It meant capitulation. It meant margin calls. It meant losses that would erase months of profits. And they had one last option. They could defend 70. They could sell aggressively, dump contracts into the market to push the price back down, create the illusion of resistance, scare the bulls into taking profits. But Caldwell knew the math. To defend 70, the shorts would need to sell at least 5,000 contracts in rapid succession. And in a thin market, that kind of selling would be visible. It would show up in the order flow. It would telegraph their desperation. And the moment the market sensed that desperation, the buyers would attack. The price ticked to $69.95, 5 cents from 70. Caldwell leaned forward. Her algorithm was flashing red. Critical level approaching. She had seen this before in other markets. The moment when a psychological barrier transforms from resistance into a magnet. The traders who had planned to sell at 70 were now hesitating. What if it goes to 75? What if this is the beginning of the real move? Hesitation created delay. Delay created opportunity. And opportunity created breakouts. The price hit $69.98, 2 cents. Caldwell held her breath. Somewhere in New York, a junior trader at a major bank was staring at his screen. His risk limit had been breached. His boss was unreachable. He had seconds to decide, hold or fold. The price ticked to $70, and the wall crumbled. There is a moment in every market crisis when analysis becomes irrelevant, when the data stops mattering, when the only thing that matters is the decision you made 3 months ago. On December 22nd, at 12:03 p.m. Eastern Time, silver crossed $70.12. And for thousands of investors around the world, that moment revealed whether they had been prepared or merely hopeful. Robert Kenji sat in his home office in Seattle. He was not a professional trader. He was a software engineer who had started buying silver in 2019, 1 ounce per month, then 2 ounces, then 5. By December 2024, he owned 340 ounces, physical metal, stored in a safe in his basement. He had paid an average of $23 per ounce. At $70, his position was worth $23,800. His initial investment had been $7,820. He was up $16,000, and he felt nothing. Not excitement, not fear, nothing. Because Robert understood something that most investors do not. Profit is not real until it is realized, and realization requires a decision. Sell now and lock in the gain, or hold and bet that the price goes higher. Every investor faces this decision eventually, and how they respond determines whether they leave the market richer or with regrets. Robert opened his laptop and pulled up the chart. He looked at the $67 level. That was the support line, the floor. If silver dropped below 67, it would signal that the rally was over, that the breakout had failed, that the sellers had regained control. But as long as the price stayed above 67, the trend remained intact. Robert made a rule for himself 5 years ago when he started investing. Never sell based on emotion, only sell based on technical invalidation. And right now, the technicals were screaming one word: hold. Across the Atlantic, in Frankfurt, a different investor was making a different calculation. Klaus Meyer was 63 years old. He had been trading silver futures for 4 decades. He had seen the 1980 rally to $50. He had seen the 2011 rally to $49, and he had learned a painful lesson from both. Parabolic rallies end violently. Klaus had bought silver futures at $62 2 weeks ago. He was using 5-to-1 leverage. This meant that for every dollar silver moved, his position gained or lost $5. At $70, he was sitting on a 40% return. But leverage is a double-edged blade. Klaus pulled up the volatility data. The average true range, a measure of daily price swings, had expanded to $4 per day. This meant that on any given day, silver could move up or down by $4. With 5-to-1 leverage, a $4 drop would trigger a margin call. His broker would liquidate his position automatically, and Klaus would lose everything, not just his profits, his entire investment. He stared at the screen. $70.18. He thought about the holiday week, thin liquidity, skeleton crews at the banks. One aggressive sell order could drop the price $5 in minutes, and he would be wiped out. Klaus made his decision. He closed half his position, locked in 20% of his capital as profit, and reduced his leverage to 2.5 to 1. It was not greed. It was not fear. It was risk management. The first rule of trading is simple: survive. You cannot make money if you're not in the game, and staying in the game means controlling risk. In Singapore, a third investor was making a third calculation. Hui Lin managed a family office with $300 million in assets. Her job was not to maximize returns. It was to preserve wealth across generations. She had allocated 5% of the portfolio to physical silver 2 years ago. $15 million at an average price of $28 per ounce. At $70, that position was worth $37.5 million, a gain of $22.5 million. But Hui Lin was not thinking about selling. She was thinking about allocation. Her portfolio construction philosophy was based on balance: 60% stocks, 20% bonds, 10% real estate, 5% commodities, 5% cash. When one asset class outperformed, it threw the portfolio out of balance. Silver had doubled. It now represented 8% of the portfolio instead of 5%. Hui Lin faced a decision: rebalance by selling silver and buying bonds, or let the winners run and accept higher portfolio volatility. She thought about the macro environment. Global debt levels were at historic highs. Central banks were trapped between inflation and recession. The dollar was losing credibility as a reserve currency. In this environment, hard assets were not speculation. They were insurance. Hui Lin made her decision. She would not rebalance. She would let silver run to 10% of the portfolio, maybe 15%, because the risk was not that silver would go too high. The risk was that everything else would go too low. Robert, Klaus, and Hui Lin represented 3 different approaches to the same market. Robert held physical metal with no leverage and no time pressure. Klaus traded futures with leverage and constant risk. Hui Lin managed generational wealth with strategic allocation. All 3 were profitable, but only 2 of them would survive the next phase. The reality of volatile markets is simple. Leverage kills. Not sometimes, always. The only variable is timing. In a thin market with $4 daily swings, leverage positions are kamikaze missions. You might be right about direction, but if the price drops $5 before it rises 10, you will not be there to collect the profit. Your broker will close your position, and you will watch from the sidelines as the market does exactly what you predicted. This is why institutions lose during short squeezes, not because they are wrong about fundamentals, but because they cannot survive the volatility. A hedge fund with margin requirements cannot hold through a 20% drawdown. The fund's risk manager will force liquidation, but an individual investor with physical metal can hold through anything, because physical metal has no margin call. No broker, no counterparty risk. It sits in a vault and waits. Robert understood this. He had designed his position to be unshakable. 340 ounces, no debt, no leverage, no need to sell. He could hold for 5 years if necessary. And in a market where the shorts were trapped and the supply was constrained, time was his advantage. Klaus understood something different. He understood that leverage was a tool, dangerous but profitable when used correctly. And the correct use of leverage required one thing: discipline. He had rules. Never risk more than 2% of capital on a single trade. Never hold through major news events. Never let a winning trade turn into a losing trade. By closing half his position at $70, he had followed his rules, and his rules had kept him alive for 40 years. Huilin understood a third truth. Markets go through cycles: bull markets, bear markets, corrections, crashes. No asset class performs well forever. But over decades, commodities provide insurance against currency debasement. And in an era where governments were printing trillions, that insurance was not optional, it was essential. At 12:47 p.m. Eastern Time, silver hit $70.31, a new high for the day. Robert checked his phone, smiled, and went back to work. Klaus adjusted his stop-loss order to lock in more profit. Huilin sent an email to her compliance officer requesting approval to increase the commodity allocation to 12%. 3 investors, 3 strategies, 3 different definitions of success, but all 3 had one thing in common. They had made their decisions before the crisis, not during it. And that is the only decision that matters.